Well, good morning. This is Rich Morrison, and thank you for joining me for the January Aftermath webinar. We'll dig right into talking about USDA's numbers, what happened here last week. Wasn't a pretty report, certainly, and it's kind of set this market on its heels here as we head into the last half of January. So we'll dig right into what's going on. Certainly, Brazil crop weather remains at the top of the list as far as the markets go. Chinese demand, we'll talk a little bit about that as well. The hedge funds, I think that certainly they've been a dominant factor in the market for several months now and continue to be here as we go forward. USDA, of course, the report on Friday, and we'll dig into those numbers here as we look at each crop. And then lastly, the other things going on outside the world, the macro world, the wars, the dollar, inflation, deflation in China, just a lot of things happening around the globe right now. So starting out at Brazil, you can see the root zone moisture map shows continued dryness through Mato Grosso, central eastern Brazil. This hasn't changed, but it's kind of reminiscent to what happened in the United States this year, where we had very dry weather. We had drought in many states, yet we were able to grow pretty good crops, and it had to do with timeliness of rainfall. And I think that that's kind of what we're seeing now. Although the rainfall in Mato Grosso didn't come quite early enough to save the early crops, it's certainly been a godsend for the later planted crops, and it's going to be really good for the crops in other parts of South America. And if you look at the last 14 days, if you go back a couple of months ago, there was a lot of discussion about the weather pattern changing as you got into middle of December. And that's really what we saw happen. And over the last 2 weeks, although the precipitation hasn't been general, there's been some pretty good amounts of precip throughout that central part of Brazil. And as you look over the next few days, it does look drier. So maybe there's something here for the market. However, the forecasts all past week 7 or day 7 turn back wetter again. And so it's hard to generate much of a rally when you're this far into the growing season. And although the crop's going to be down from where it had started, it looks like it's still going to be an ample crop in Brazil. Couple that with a big crop in Argentina. Looks like we're going to see, once again, a big South American production number. Talked about the hedge funds just a second ago, and certainly I think they've been a dominant factor in the marketplace. If you look at what they've done over the last 2 years in the ag world, and this map isn't just showing the crops. This is showing livestock, cotton, sugar, coffee, cocoa. So this is all ag markets combined. But if you look at what's happened over the last 2 years, and Peak Trading shared this chart, you can see back 2 years ago in the winter, these funds were long about 800,000 contracts net in the ag markets. And what they've done over the last 2 years is proceeded to liquidate most of that. But yes, we have seen some rallies, certainly, and that's indicated by the green on this chart. We had the Ukraine invasion. We've had weather rallies certainly over times, but overall we've continued to see liquidation in the ag sector, and I think that had to do with the fact that we had such an oversold ag market 2 years before that. People saw that as saw ag as a really good opportunity coming out of COVID in late 2020, early 21, and we saw huge buying in the ag sector. But as often happens, and we'll talk about this with each crop, when you have high prices, what does it do? It crushes demand, and it incents more acres to be grown, and that's what we've really seen happen, especially in the crops over the last couple of years. To the point now where these funds are now short almost 400,000 contracts combined in the ag sector. And just in a shorter term, you can look at this other chart from Peak Trading just in the last couple of months. You can see that net selling that we've seen in the grains, the oil seeds. Now back here in late November, early December, you did see a little buying in the grains. And that was weather related. But since then, it's been net selling across the board. So let's start out looking at corn, and we'll look at USDA's numbers. Maybe the surprise once again was in the corn, where we ended up with a record corn crop according to USDA, 15.3 billion bushels of corn. And that estimate was right at the top end of trade guesses, and therefore was very bearish when that report came out on Friday. And 177.3 bushels per acre ends up being a record corn yield in the United States. Who would have thunk it, based on a lot of the reports we were getting during the growing season? And we really didn't have that many states have record numbers this year. Indiana, Ohio, South Carolina were the only three states that posted a record corn yield. And so what really ended up happening this year is we had a lot of states with good yields. We didn't have as many records, but we had several states posted strong numbers. We saw a big bounce back in the upper Midwest, in the central part of the country, Southern Plains, Eastern Corn Belt certainly was pretty good. The trouble spots, I should say, were probably in the Mississippi, upper Mississippi Basin. But even then, we saw USDA improve some of these numbers from last month. Illinois was up 3 bushels. Iowa was up. Minnesota was up. So all these lower numbers did get better from a month ago. And so what was the impact in the balance sheet? Well, let's start out looking back a couple of years ago. USDA made a few tweaks to the balance sheet. They reduced planted and harvested acres the last 2 years, cut production, but they offset that with cuts in demand. So ending stocks really didn't change. But if you look at this year's numbers, the final production numbers for this year, acres down slightly in this report, but yield was up more than 2 bushel an acre to 177.3. Production up to 15.342 billion bushels. That's a new record high. USDA did offset a little bit of that with increases in demand, feed demand, ethanol demand, but still, even with more than 600 million more bushels of demand this year, ending stocks still rose 30 million bushels to 2.162 billion bushels. And that continues to just hang over the heads of this corn market. And I've talked about this for more than a year now, but this year, 2023, I think was very similar to 2013, where you had come off of a high in 2012 and you increased acres of production the following year. You decreased demand like we saw here with just 1661 last year. And when that happens, you start to see stocks grow quickly. And that's what we're seeing here going into 24. Same as we saw in 14. Average farm price forecasted at 480. That was down a nickel in this report. Now, the USDA is saying we're going to export more corn this year. That has to happen. Go back and look at the chart or look at the table. You know, exports are expected to bounce back up 400 to 500 million bushels, but still well below the 2 years we had previously. And so in order for us to chew through this big stocks number, we need to have that export number pick back up. Good news, we've had a few good weeks of good export shipments so far. This is not our big season for corn. That usually starts in March once the bean loadings slow down. So we'll see what happens here as we get into spring. But one of the issues that the corn market does have, I think the big bounce we had 3 years ago was due to China. And right now we're continuing to see negative Chinese economic news continue to flow out of that country. A lot of deflation right now. And that is probably hurting any chances of seeing China come back into the U.S. corn market. Stocks to usage in the United States, back up close to 15% again, back where we were in the middle of the last decade. And that's not conducive to good prices. At the world level, we're continuing to see it creep a little bit higher. So the funds always anticipate and they get out in front of this thing. If you go back and look at their positions back in the purple line, late 2020 was when these funds really went to the long side of the market. And that happened to coincide with about the time China started buying U.S. corn. And for about 2 years, these hedge funds held long positions, very large long positions in the corn market. The red line was this past year, and in early 23, they started to sell. 2 big reasons. Number one was a record Brazilian crop that was starting to get harvested. And then we were talking about, of course, reduced demand in the United States while we were talking about bigger corn acres getting planted this past spring. And since then, the funds have primarily been on the short side of the market. We've had a couple of weather bounces back in June and late summer, but the funds, as of last Friday, these hedge funds are short 230,000 contracts of corn. That's over 1 billion bushels of corn. Now, there's 2 ways to look at this. Number one, everybody's negative right now. But from a positive perspective, you'd say that historically they haven't been much shorter than this, that if anything positive were to come about, it would give these people some reason to buy back that short position. We saw that in soft red winter wheat back in early December when the funds bought some wheat. So can that happen again? Yes, it can. What are the odds? I don't know right now. I think that these hedge funds, I think that they all recognize that the biggest opposing side to them right now is the U.S. farmer. And the U.S. farmer's holding a lot of corn, probably 8, 9, 10 billion bushels of corn. And so they recognize that the farmer will probably sell at some point, and that's going to continue to keep pressure on this market. So I think the trend is their friend at the moment. Can something change that? Yes. I think if certainly something like China buying would be a positive. I think if you get into dry weather during the safrinha corn crop in Brazil, that's yet to even be planted, that could be a positive. And then lastly, it'd be the U.S. growing season. Something happens in the U.S. growing season, either reduced acres or drought. Certainly that would give these people reason to buy back. But that's what we really need to have happen to get this corn market to turn. And until then, it looks like the trend is down. We've trended lower since the highs were in last summer. We broke below this support line here at the beginning of the year. We've gone down and made new lows here to start the week again. Best thing I can say about March corn right now is the RSI at 28 and stochastics in teens would tell me this market's getting closer to oversold than anything else right now. Certainly the biggest hurdle back to the upside would be the 9-day moving average at 459. And then you've got your other moving average lines above that. Now, the one thing I think that producers want to look at if they have the storage space this year is taking advantage of the carry. And I've written about this a little bit over the last month or so, but the carry opportunity in the market right now is substantial. From March to July, 21 cents currently. And so I think that the market is going to continue to entice people to store corn. It has to. With over 2 billion bushels that's going to get carried into next harvest, someone's going to have to be financially incented to hold the corn. I would expect these spreads to continue to widen. The July, September at 6, I think that's probably going to push out to at least 8 cents. I think the SEP-DEES is going to have to widen again, probably closer to 4 or 5 cents a month to get somebody to hold this corn into next harvest. I don't think farmers want to be the ones to do it. So beyond that, it's going to have to provide an incentive. And I think that's what elevator managers are certainly looking at. But I also think from a producer standpoint, that's your opportunity, is not to sell against the March, but to be forward selling out against the July contract. Whether you're hedging July corn, whether you're selling cash out into the May, June, July, whatever the case is, try to earn that carry where it's available this year. Looking ahead to next year, USDA put these baseline numbers out back in October. They were forecasting 91 million acres of corn, down 3.6 million. I would not disagree with that. They're saying a yield number at 181, which sounds awfully high. That's still the trend line number. We'll see if we can ever hit that, but that would give us a crop at 15 billion bushels. They are forecasting better demand, but even with that, not achieving or not using up what we raise, and stocks rising to 2.6 billion bushels a year down the road. Again, I think that's a little aggressive. I think 181 is a little aggressive. If you cut that a couple of bushel back, now you maybe cut 200 million off of this number, but it's still a big, big number. And so it would tell us lower farm prices. USDA saying 450. I would think a 2.5 crop carry out 2.4 probably leads you down into the low fours in the year ahead. So does December corn have more downside? I think it does have downside risk. I think probably down into the low fours in the year ahead. We did gap lower to start the year. You can see that right up here around the $5 mark, just above 5, and just hasn't looked back since then. Again, kind of like the March contract, the best thing I can say is that the market's very oversold right now, probably due for a correction. Maybe that can happen this week if we get the rest of the people that want to get short the market out of the way. Maybe this thing can get some legs back under it. The 9-day moving average at 492, probably your next upside target, of course. And then the blue line, the 20-day moving average at $5. Certainly those would be big targets to look at. One note that I do want to, and by the way, I've suggested being a 35 to 40% sold at $5 again. If you look back a couple of weeks back, I did write in the market report some put option strategies this year. Basically a min-max where you're buying a put and selling a call. I don't think today's the day I want to be doing that, but what I was looking at 2 weeks ago was a way to buy a $5 put, sell out of the money call options, and take a ceiling to be able to pay for that put to get me a floor price close to $5 this year. And I think that that's a pretty good strategy, considering I do think that the upside is pretty limited, barring a substantial problem, while I do think the downside has more risk. And so I like that type of strategy on the next rally. Certainly, in addition to making sales, I would look at something like that min-max. One other comment I do want to make, the margin protection price last fall was set at 509. Anybody that bought that policy right now, it's a long way to go, but if the yield in the county next year ends up right at the expected county yield, then as of today, we would be starting to trigger a little bit of a payment at the 95% level. So we'll get the final input prices set in the month of April. So we're still a couple of months from that. And of course, we haven't grown the crop yet. But the point is that this policy is working for you right now. And then the last thing I do want to show this chart, which I think is maybe the most important. If you look historically, stocks to usage ratio versus average farm price, I call this my Captain Obvious chart because it really points out what we already know, that when we have high stocks, we tend to have low prices and vice versa. Well, here we are again this year pushing 15% stocks to usage. And what happened following 2012, I think is very pertinent to look back at, because in 2012, we had a very high price. And the following year, we increased acres, demand dropped, and farm price fell. And again, the following year, it fell because we still had not increased demand enough to chew through that extra surplus of production. Fast forward to 2022, very similar to what we had in 2012. You had a big rally, high price. The following year, 2023, average farm price forecasted lower. And I'm thinking probably lower prices again in the year ahead, unless something changes dramatically to either really kick in export demand or really cause a drop in production. So that's what we want to protect against here this year. Switching over to soybeans, the crop wasn't a great one in soybeans, 4.16 billion bushels, the final production estimate. USDA did raise their yield number to 50.6 bushel an acre, just about trend. And you can see by state where we ended up this year. The blue states higher, red states lower. We did have a few record states, Indiana, Ohio, Arkansas, Mississippi, South Carolina, all had record bean crops this year. But we had a lot of blue states on here. So a lot of states did a little bit better than what we saw a year ago. And USDA did tweak the harvested acreage number down while they bumped the yield number in the report. So took production up to 4.165 billion bushels. That was up 35 million bushels from back in November. That's the only change they made on the balance sheet. Ending stocks ended up at 280 million bushels. Now, that's still below 300 million, which historically is, I think above 300 is a loose situation. When you're below 300, you're still on the snug side. And so that's why we still have prices in double digits. 12.75 average price this year. That was down 15 cents from last month, but still not a burdensome overall U.S. situation. The big positive on that demand picture continues to be the soybean crush. We continue to see a new record crush each month. We've got more capacity coming online with new plants being built and or old plants being expanded. So that's the big positive there. The negative in beans is the export demand. And you can look at see what's happened over the last 3 years. We went from a record back in 2020, 2021, dropped the following year, dropped the following year, this year down once again. And two reasons for that. Number one was high price, but number one was Brazil having a record crop last year. And so we continue to see more and more competition. And that's caused our exports to slide. Brazil has been shipping beans all the way into our harvest window. You can see this October to February window is usually our big shipping period. and that's not necessarily been the case lately, especially. So we'll see if we can meet that 1755 number even before the harvest kicks in South America. Now, one of the biggest issues that we've had continues to be China. When you look at China imports overall, this isn't just grains, but they've had several months in the last year where inputs have been down or imports have been down. They've actually been suffering from deflation in China. So their economy is going backwards, and that's not been helping demand for anything, especially soybeans, cotton, those crops that we really rely on China for some extra demand. We did see them buy a little bit of soft red winter wheat, but they have not been in the corn market like they had been in past years. So that's an issue. The other big issue for the market remains South America. And these numbers didn't quite update. These were from last month. USDA did bump Argentina to 50 million tons. They took Brazil down to 157. Still would be a record between the two countries. Now, we have seen several analysts been dropping their Brazilian number down around 150, 149 lately. Here just this morning, I saw a 140 number. So people are dropping that number down. But even so, it would probably still be pushing a record combined production between these two countries, even if that crop does get smaller. And why does it continue to matter? Well, if you look at the size of what Brazil has meant to the world, how that's changed, or South America, I should say, or the lack of U.S. influence. You go back to the late 60s, the United States was accounted for about 75% of world bean production. By the late 80s, that had gone to half. And by the later part of the last decade, about a third. And I would guess the U.S. production now closer to a fourth of the world overall production. So South America continues to mean more. We continue to watch the weather situation down there more and more each year, and that continues to be really the driver in this bean market. So looking at stocks to usage, in the U.S., we're going to see that number creep a little higher this year. At the world level, it's expected to jump quite a bit if that South American crop does hold. So again, the funds had spent the better part of a couple of years on the long side of the market. Here this last spring, we saw them liquidate back to zero. They had a weather-driven rally in June and July where they added length again, sold it back down into the fall, had a Brazilian weather rally here in November, sold it back down, and now as of this past week, they're short 31,000 contracts of beans. So not a good picture for soybeans. Now, the question is, do they do what they did in corn and push down near record short? Or are they comfortable just being on the short side of the market right now? I could make a case still. You've got a lot of growing season left in South America. There's still some risk. However, if they perceive this world situation as bearish, then maybe they decide to continue to lay on this bean market like they have in corn and in wheat. And if that's the case, then we've got some downside risk. One of the big downside drivers has been the meal market. And you can see what funds have done in meal. And we had a huge meal weather rally this fall. And then the meal market has just been tanking here lately. And so, again, that's part of the driver in the selling in the beans. But March soybean futures here at the beginning of the year gapped lower. Then we broke quickly below the downside of this channel, which had held us for about 6 months. Where do we go from here? The risk right now sits here back at the May low. Many of us forget that we traded soybeans down in the 11s clear back here this last spring prior to getting a weather rally. The only positive, again, I would point out is the RSI at 24 and stochastics dipping into single digits would indicate this market's probably very oversold right now. If we're able to bounce, turn back around, first hurdle is going to be the 9-day moving average, just above 1250. Then you got your other moving average lines up here as well. But if you got old crop beans to sell, certainly that 9-day is probably your first target back to the upside. Looking ahead to next year, most everybody's in agreement that we're probably going to add bean acres in the United States, which is also something that I think is weighing on the market, probably in fund traders' minds as they're positioning in this market. So 87 million acres with 52 bushel yield could produce a record or close to a record bean crop this coming year. But USDA is pretty optimistic on demand. And so they're still thinking maybe we don't get above 300 million in the year ahead. Now, that said, they are still forecasting a lower farm price at 1130. And that probably takes into account what we would expect to be a big South American crop. And so that the other part of this, it's not just about the United States, but it also includes South America. And so if you look at the US or you look at November futures, again, they gapped lower to start the year. We failed here just recently to get back above the 9-day moving average, market dipping below $12. Again, the indicator is very oversold right now, but what's the risk as we go into spring? If the South American crop pans out, and if we're talking bigger acres, our risk is very obvious. It's the May low at 1116. That would be the first downside potential number. And so again, I think being a third, 40% priced on new crop beans, early on it was $13. I would hope that we'd have a chance to go back and fill this gap now at 1230 to 1236. I think that would be a tremendous target to be looking at making some catch-up sales. Those that purchased the margin protection policy, we had that base price at 1295. So we're over a 5% drop from that right now, which means that we're probably, depending on what your county yield is next year, we're potentially in a payment type situation. So that policy, again, is kind of in the money at this point. So one last look, the Captain Obvious chart once again on beans, very similar to corn, where we had highs back in 2012, 2022. The following year, you saw increased production around the globe and you saw demand start to get cut. And then the following year or two, we saw prices continue to drift lower. So I do think that that's the risk that we have in beans like we had in corn. And again, a reason that we want to stay ahead with some sales. On wheat, USDA only made one little change. That was in the feed number from 2 years ago. They increased that number, so it did drop ending stocks slightly, both for this, for all the last 3 years. But stocks are still forecasted to be up 78 million bushels this year. Ending or average farm price, USDA did lower it to 720 in the report on Friday. Now, there's been a little optimism lately when China came in at the beginning of December and bought soft red winter wheat. And you can see wheat export shipments have started to pick up a little bit. We've had a couple of decent weeks of shipments in here. Stocks to usage at the U.S. level, we're going to see a jump this year, and most of all of that's in soft red winter wheat. World numbers continue to dip slightly, and so maybe there's a potential story there down the road. One other positive for the wheat market was Friday's winter wheat acreage number. 34.4 million acres this year was down 2.3 million from a year ago. You can see the red states were all down, blue states were up. So we saw several states, a lot of states saw dramatic changes, drops in winter wheat acres this year, especially the southern soft red winter wheat states. But even in the hard red winter wheat belt, we saw a drop in winter wheat acres as well. So maybe that's something to give this market a little support. And that number was at the very low end of the trade estimates that we saw going into the report. So should have been a little bit supportive to that market. Now, looking ahead to next year, USDA was predicting lower acres, but projecting a bump in yield and projecting a bump in stocks down the road a year. And so they're projecting a farm price drop down to 680 a bushel this coming year. So we'll see what happens there. But the funds have been short for a long time in soft red winter wheat. Now, again, what would give us hope in some of these markets is what the funds did back in December in wheat. When China blew into the wheat market unexpectedly, funds took their net positions from about 120,000 short to about 60,000 short pretty quickly. Gave us a nice little rally, about an 80-cent rally in soft red winter wheat. So to me, that tells us what can happen if we get these funds back on the buy side of the market. And that shows you here. We'd rallied from 586 to 666. Since then, the market's settled back down again. But it does show what the potential is if you get these funds in the market. Technical indicators leaning a little bit to the oversold side right now. We're back below this cluster of moving average lines. If we can get back through that, my hope would be for a sale up around 660, which is where the crop insurance base price was. I think that's always a good sales target. And we'll see if we can get back there. But to me, that would be a great place. I'd want to get a big chunk of wheat sold for next year. Kansas City wheat, very similar looking fund chart. The funds bought KC wheat when they bought Chicago wheat after the Chinese sales. Since then, they still seem to be happy being on the short side of the market. We're not at a low, but we're not far from it right now. Stochastics and RSI continue to indicate an oversold market. So can we go back up? Maybe. I would look back at this 680 level, probably 677 was the 100-day moving average. I think that'd be a good target to be making some sales. I think the crop insurance price, I would probably put some offers in, but that would be a lot harder to get to, it looks like, in KC wheat. Finally, Minneapolis wheat. Got the funds having made a record short here in the last couple of months. Nothing really to talk about here. Demand has been a struggle, and I think that the trade thinks that we're probably going to see more spring wheat acres get planted this next spring, probably less corn up in North Dakota, Minnesota. And so that's continued to weigh on this market. And this market very oversold. Again, the indicator's oversold. We made a new low here on Friday. So can we try to rally? Maybe. The margin protection policy looks like a pretty good deal right now at the 805 price. We're down right at about 10% right now. So it would be in the money with an average yield in the counties for next year. Finally, cotton. Cotton is the one crop that probably had a supportive report on Friday. You can see USDA lowered production again to 12.4 million bales. That production estimate was at the low end of trade estimates going into the report, so it was a little friendly. The yield at 845 pounds this year. That was up from where it was last month, but USDA made some adjustments to the acreage numbers. But if you look at the yields, the Southern Belt was certainly where we were down this year, but nothing more than Texas. Texas down 32%, and that was the big reason that production dropped. USDA did, as I mentioned, make some tweaks. They did lower harvested acres while increasing the yield, but production went down to 12.43 million bales. Now, that by itself should be a little friendly, but this export number continues to go lower. And that's, again, in response to what's going on mostly in China right now. So even though ending stocks at 2.9 million bales, that's a snug number, the market has just not reacted sharply to it. And again, this Chinese economy seems to be the negative factor. But if there's a reason to be somewhat friendly to cotton, it's probably stocks. You still look at the world level, you look at U.S. stocks this year, stocks to usage going to drop in the year ahead. And so while the funds have liquidated their cotton, that might actually turn out to be somewhat of a friendly thing because they don't own anything now. Maybe they get back on the long side at some point. But you can see going back to last fall, they were long over 50,000 contracts. Now they're below zero. And you can see the impact on the market since then. They went from 90 cents to 77. And since then, we've trended a little higher. And so I would be cautiously optimistic on the cotton market. Maybe we can bump this back up to 82, 83 cents again. Excuse me, indicators are pointing a little higher right now. So that's a positive for this market. Going into next year, I'm not sure that I believe USDA. They're thinking we could see 1.5 million acre increase in planted acres. That seems like it would be a stretch to me this year. We'll see. A couple of people that I've talked to don't think that that's likely. So, but even with that type of a number, they're optimistic on demand, and stocks still would not grow a lot in the year ahead, 3.64 million bales. Farm price, they're saying unchanged. But again, I think this acreage number is probably a stretch. So might be something positive here to build on. And I think that the trade has kind of figured that out as well. After we got the funds liquidated out of their longs, now the channel is trending higher. And so even short term, you might even be a little overbought. Stochastics in the 80s would indicate this market may be getting a little bit toppy right now. But as far as targets go, pricing wise, can we get back up to the 82-cent fall high? That I think would be a great place to A, maybe be a hedger, and B, look at that min-max type strategy again, like I talked about in corn. If I can buy an 80-cent put, sell 85, 86-cent calls to pay for it, get me a floor into the market with a little upside, I think that would be a good thing this year. And so I like that type of a strategy, again, for new crop cotton. Switching gears to the government programs. Once again, this year, we have to make an election between PLC and ARC by March 15. Because because Congress did not come up with a new farm bill, they extended the current bill. So once again, we have to choose between those programs. And the decision, again, to me, boils down not to PLC versus ARC, but it's between ARC and SCO, which is a crop insurance program. And I wrote this letter, and I've included this with my market report, talking about reasons for how to go about making that decision. But just kind of a step back, the PLC program is this blue box. These are a price loss coverage program. And if the market year average ends up below these numbers, then you're going to collect the difference times the payment yield at FSA times 85% of your base acres. Keep in mind that PLC and ARC cover 85% of your base acres. Crop insurance programs like SCO cover 100% of your planted acres. So if you don't have a base of a certain crop, then you might not want to look at the programs. But for this year, the 2023 crop year, these are the current market year average prices in the gray box. None of these crops are going to pay PLC money this year. We kind of knew that last year when we signed up, that PLC did not look like a good option. So we looked at the ARC program. ARC used the numbers in the red box. These are 5-year Olympic average numbers. So we take the high and the low and throw them out, average the other 3 of the last 5 years. Take that number times your county's 5-year Olympic average yield times 86% to come up with your trigger for the county. Well, those numbers weren't great either because they were pretty low prices. And so we looked at a program called SCO, Supplemental Coverage Option. SCO is a crop insurance program that's very similar. It also has an 86% county trigger. But it uses the crop insurance price that was set in the month of February here in this green box, and which was so much higher for crops like corn, soybeans, spring wheat, and other crops that it made more sense to buy SCO and pick up a lot of extra dollars of coverage than to sign up for the ARC program. So last year, a lot of us bought the SCO, and if we did, we then had to enroll in PLC, because the government will not let you buy SCO and sign up for ARC because they are almost very similar programs. So that was the decision a year ago. This year, things are changing, because if you look at the 2 columns on the right, the dark red column is what would be the ARC benchmark price this year at 485 corn, 1112 beans. Those have come up a lot because we've dropped off a low price year of 2017 and added a high price year of 2022 into the formula. But the crop insurance price, which we're going to start setting depending on where you're at here in the next couple of weeks, those numbers are going to be down, it looks like, from last year, to the point where for corn, the ARC program probably looks like a better deal than paying for SCO. But that is if I have corn base on my farm. If I have a farm with no corn base and can't get this protection, then maybe I still want to look at SCO. For soybeans, I would still favor looking at SCO because it does have a 90-cent better price right now. Spring wheat, I still might look at SCO. For cotton, one of the discussions there then is, do I buy stacks or sign up for a farm program? If I decide to buy the stacks policy at 90%, which is subsidized at an 80% level, if I buy stacks, I cannot sign up for ARC or PLC. So that is your decision you have to make. And that's why I encourage farmers to talk to your crop insurance agent first before you go to the FSA office and determine, does it make sense for me to buy SCO or not this year? And if it does, then I have to enroll those crops and those farms in the PLC program. If I do not buy SCO, I'm probably going to sign up for ARC because the prices are quite a bit better this year. So hopefully that gives you a hint, and check out that letter. I'll continue to update that here as we go forward. So some tools to look at. We've talked about SCO. That's, again, 86% county level coverage. SCO starts at 86, goes down to where your individual coverage leaves off. So if I buy 75% underlying RP coverage, SCO would have 11 points of county coverage stacked on top. Then we have ECO, which takes it to the next level. ECO starts at 86 and goes to 90 or 95. And that's what this graphic shows you. shows you how these different coverages stack on top of each other to basically determine how much of your deductible you want to get rid of. And so my multi-peril starts at the bottom. I can buy revenue or yield coverage up to as high as 85%. The next level is from the blue up to 86. That's where SCO or ARC would come into play. You can't do both. You can do one or the other. ECO you can do no matter what you do with the ARC program. So even if I decide to take ARC on corn, for example, I can still buy ECO coverage from 86 to 90 or 86 to 95%. So we developed a tool called the Producer Profitability Matrix. And the idea behind this matrix was to be able to look at how using SCO, ECO on top of your individual coverage would hopefully help you be able to lock in a profit. And so this is an example from last year. And on the right, it shows our expenses. I've got farm expenses in red, and then I've got one line here for crop insurance. I want to keep that separate so we can look at what the impact would be of adding the SCO or the ECO. We've got our forward sales here in green. So any bushels that I forward sold, bushel per acre here, and the average contract price. And then on the left-hand side, we've got our crop insurance decisions. And so we've got our county, we've got our individual APH, expected county yield, the base price for the policy, which last year was $591, the individual coverage level that I buy, then SCO, do I add it? Do I add ECO? And how much of the dollars of coverage do I add? And so for this first example, I'm going to show last year a person that bought 80% RP coverage, didn't do anything else. Then in the matrix down here, we've got yields across the top. We've got county and individual yields, and we've got harvest price down the left-hand side. And I'll give you a hint what happened. We ended up at 488 corn, somewhere down here between the second and third lines from the bottom. And so for a producer that had a yield right at his APH, and I use 200 bushel an acre, this producer is actually losing money right now. If he didn't forward sell any corn, didn't have any higher coverages, we're actually sitting in a loss scenario right now. And so hopefully guys took advantage of that high price. One of the ways was adding SCO last year. And so if the producer did the SCO, you would add a county level band from 80 to 86%. And while it didn't quite turn everything positive, it did get you very, very close, even after I add the additional few dollars of premium. What if we went to the ECO coverage last year? I was a big proponent of this because of how high that base price was and what the opportunity was to lock in a profit. And so even by more than doubling my insurance coverage last year, insurance cost, I was able to guarantee a profit no matter what happened last year because of having that trigger up to 95% at 591. And so no matter what happened, we were looking at locking in a profit. What if we went another step further and forward sold 40%? We were talking about that last winter. And if we sold 80 bushel an acre at the insurance price at 591, now actually down here at 488 corn, I'm making about $150 an acre this year. So this was the big discrepancy this past year. The opportunity we had with high price, hopefully guys and gals took advantage of that and were able to lock in some really good revenue numbers for this past year. For the agents that are on the call here listening, one thing, if you haven't looked at this tool, as you scroll down below this matrix, it'll show you a breakout of each individual part of the insurance and the marketing as well. So this shows me my 80% RP policy, where it's going to pay, yield and price. It's going to show me the 80 to 86 SCO. It'll show me the ECO from 86 to 95. It'll also show me the marketing, et cetera, the other parts of that as well. So looking ahead to this coming year, what can we do? Well, it's not going to be as easy. You know, we had some great opportunities last year. If I put the same plan in place that I did a year ago, it doesn't look as good because the price of corn is significantly lower. Maybe our farm expenses are going to be down a little bit. I think insurance premium is going to be down a little bit. So we're still not looking at profitability in all cases. Maybe I don't sell as much corn today. Maybe I sign up for the ARC program and do not buy SCO, save a few dollars coverage there. I can still have my multi-peril at 80 and still buy the ECO that goes from 86 to 95 if I want. So I can leave that gap and let the ARC program cover that. I can lower my dollars of coverage, this green 100% number. I can lower that down to as low as 50%. What that does is essentially it lowers my payout 50%, but it lowers my premium 50% as well. So that's something you may want to look at. So there's a lot of combinations that we can look at this year, but certainly I think this tool is a great tool to be able to help you be able to look at the different combinations from a profit loss standpoint. Plug in your farm expenses. Don't use the university numbers. Use your own if you can. And so be able to look at how you can build a plan this year that's going to hopefully cover your cost of production. So coming up, we've got right now through the middle of February, we'll be setting our insurance prices in the southern states. We'll start here in February doing it in the northern states. We'll have our next WSDA report on the 8th. We'll talk all about it in the aftermath on the 9th. Markets are closed for President's Day on the 19th of February. And then we've got several sales closing dates coming up. February 15th in the deep south, February 28th in the mid-south, March 15 throughout many other states. So I encourage you to check out that matrix, encourage you to get some offers in at realistic numbers to be selling, to hopefully get ahead of a downside market this year. And but certainly look at how the revenue insurance policies can help you once again this year. So thank you for listening to the aftermath this month. Hope you have a good rest of your winter, and we'll look forward to talking to you again real soon.